Hey everybody, welcome to the 40 Finance channel. Today we're going to be talking about an ETF called the TQQQ. And what this is a triple leverage version of the QQQ. So, triple bullish on what the QQQ could do, both in the short term and the long term. So for this video, we're going to take a quick look at exactly what the TQQ is for those who don't know. Then I'm going to knock out some of the common concerns that people would have with an ETF like this. There is risk involved. It's not for everybody. We'll talk about some of the worst case examples. All right, so what is the TQQQ? It's an ETF from ProShares, and it seeks daily investment results before fees and expenses that correspond to 3 times the daily performance of the NASDAQ 100. You'll notice that they stress daily, and that part is super important to understand with TQQ, especially if you're trying to project, let's say, the downside. So let's pretend your share is worth $100 on day one, and the QQQ goes down 7%. Well, you're triple leveraged, you're going to go down 21%. So that takes your shares from 100 down to 79. Then the day is over. You wake up the next day, your shares are worth 79. So if you can picture the fact, if you had 7 straight days of the TQQ going down 20%, yes, you're losing money, but you're in no way, shape, or form close to cutting down to 0%. And of course, 7 days of minus 20% would be a fairly significant historical event. All right, basic facts here. Expense ratio 0.95. This is definitely not a Vanguard fund. However, I would say that 0.95%, you are coming in well below the average private mutual fund. And you're going to be about in ARC territory, I guess you would say, almost a managed fund, expense-free at 0.95%. The key here with this one compared to other leveraged ETFs is you have insane trading volume, absolutely insane trading volume, which of course is important not only for liquidity aspects, but even the simple observation, anytime you're in this much volume, the fund certainly has plenty of good reasons to stay solvent through anything that would happen. So in my opinion, insolvency is not a concern for this one. Obviously, there could be a 1 in a million event, but if we get to that 1 in a million event, probably the whole stock market's in deep, deep trouble. All right, quick look at the holdings, and stock-wise, it's the exact same as QQQ. You've got your lead off with Apple, Microsoft, Amazon, Facebook, Meta, your 2 Googles, even all the way down into replicating, the Pepsis and the Costcos and the Qualcomms. They're all in here just like the regular QQQ. What does get added, though, is their credit swap so that they can maintain the triple leverage price performance, right? And the math behind all this, to be fair, is a little bit beyond my IQ level, but it basically allows them to mimic very similar moves in price that the QQQ makes. Okay, and just to illustrate some of the risk here, let's go back pre-pandemic in a scenario where, let's just say you purchased the TQQQ on, looks like February 19th. You bought in your first and only share at $29. Then you walked away from your stock account and you have no idea what happened from there. You didn't add any shares, you didn't sell any shares. And in that situation, obviously the market tanked, and it looks like your low hit around 320 here, or excuse me, on March 20th, you hit your low, which was $8.88. So from February 19th, you went from $30 down to approximately $9, and you didn't dollar cost average at all during that time. And assuming you still hung on to 1 share, maybe somewhere around, well, this line for sure, somewhere around July 20th, you got to $30. You went back up to $30. So during the worst of times, you lost 3x. And that's what this blue line here is. That's the QQQ. You lost 3 times as much as the blue line. And just for fun, I put the SPY in here on the green line. And even when you got to July 12th, you can see the returns on TQQQ were actually less in total. It was 5.84% for this stretch versus 16% for the QQQ. Now, the important thing here is this is just an example of owning one share and doing nothing. Obviously, the best traders, including those who do QQQ and SPY, would have added somewhere down in this low area to bring up their returns. Now let's flip the calendar ahead 1 year from that point, and you can see if you had one share each of all three of these, the SPY, the Qs, and the TQs, you would actually be up starting July 6th, 2020, you would be up 150% through July 6, 2021, versus QQQ would be up 41%. So either way, you're winning, but with TQQQ, you've tripled the good times to come out 150% ahead. The purpose of showing you these two charts is, here's how bad it looks when things go wrong, when you're losing 3x, and here's how good it can look when you're gaining 3x. And quite honestly, it just boils down to an appetite for risk on whether or not it's something you're interested in. Now, for me, the top reasons I bought in just one share so far for TQQQ is because, number one, there's obviously going to be volatility in this market this year. We're already seeing it. And frankly, I just don't really see how we're not in the midst of it, particularly if we're going to keep talking about how many rate hikes are going to happen through the end of the year. Now, important to note that personally, I believe the top 100 stocks in the NASDAQ are in a pretty good place in terms of revenue growth and EPS growth, certainly over the next couple years. Now, are all top 100 stocks, bangers that you need to go out and get right now? No, but when you look at the top heavy side of it, just say the top 10 or whatever, the Apples, the Googles, whatever, they make up about 50% of the QQQ anyway. And in recent weeks, these are all stocks that have pulled back very slightly, and they're getting much, much closer to their historic fair values. And then the other factor is sitting right here on the screen, right? S&P 500 earnings are expected to grow 9% in 2022. Now, 9% is fantastic, and that's not a bad year at all in terms of growing your money. We know that inflation's running high, so I still think you break even for sure on the 9% side. But when I look at 9% and we recognize that S&P grew like 25% or so last year, I'm saying I need a bit of a turbo boost, at least in some percentage of my portfolio. And knowing what we know now about stocks that don't have earnings, are running very high on their valuations, I think that the top heavy QQQ is a great place to look to try to maximize those gains. Now, if you've never heard or looked at a leveraged ETF before, you might have some simple math in your mind that says, well, geez, moron, if it goes down 33%, if the QQQ goes down 33%, then your fund's going to go down 99% and basically disappear off the face of the earth. And technically, your math is correct. However, thanks to circuit breakers in the stock market, it is basically impossible for that to happen on a given day. And remember, TQQ trades and resets on a daily basis. So we are most concerned about a one-day stretch of a 33% drop. And using Investopedia here, if you're not familiar with circuit breakers, since February 2013, there have been market-wide circuit breakers that respond to single-day declines in the S&P 500 index. So yes, this is for the S&P 500 and not the QQQ, but if you haven't looked here lately, the top portions of the S&P index and the top portions of the QQQ are basically mirror images of each other, with just a few exceptions in the top 25. So here's how this works. When the index falls by 7% below its previous close, it's a level 1 decline. Level 1 declines and level 2 declines close the market or pause the market for 15 minutes. A level 2 decline, it's another 15 minutes, refers to a drop of 13%. Finally, a level 3 decline refers to a drop of 20%, and a level 3 decline closes trading for the day. So if you had this massive 20% drop, it would come after two 15-minute pauses in the market, which, by the way, it's not even like a timer that goes off at 15 minutes and 1 second. It's actually run by regulators, and they'll take as much time as they need to make sure that the market is in a safe place. But if you do get to this minus 20%, then trading will be closed for the day. Yes, that'll be a very, very bad day for your TQQQ. You will go from minus 20% in QQQ times 3 is minus 60% for your TQQQ. So the most important thing, if this were to happen, both on S&P or the TQQQ, you have to have the mindset of buy the dip. I mean, you just have to be programmed to think about what you own and what you believe in and reset your cost basis on this opportunity. If you're the type of person who would freak out in this situation and sell everything you own, then it's probably not a good idea to be anywhere close to a leveraged ETF. Okay, so what I wanted to do in this video was not only tell you that I bought a TQQQ share and will likely add more as volatility continues on, because I think the top of the market is in a relatively good place this year, and I don't mind taking some hits between now and, let's say, the next quarter or two for a long-term run. Now, that being said, I also wanted to show the viewers, like, hey, this thing gets super choppy, and the key to the whole thing is to average down. Not only that, but you have to have an inherent belief that the future of the stock market goes up and to the right. Now, there's one last component you might have thought of that I'll cover on another video, but there's a lot of rumors about decay in triple leveraged ETFs, and the thought that, you have the expense fee, you have a constant resetting. What happens in the worst of times when you have a terrible bear stretch coming on for the market? And the short answer to that is it's basically been proven false across not only actual time periods, but it's also been studied by many investors much smarter than me. And I would recommend you go into Reddit and type in TQQQ, because that's where I started reading about it. Finally, the other thing to keep in mind, particularly if you're sitting at my desk, is the fact that most people who are going to play the TQQQ are going to be hedged in ways that maybe they didn't even think about. So for me, I have single stock exposure, as most of you know, and I have the option to buy other treasury ETFs or perhaps even other single stocks that tend to ebb when the QQQ flows, right? So when interest rates do go up, maybe you have a hedge in a finance company or a bank, something like that. There's a lot of ways to play it, but I think the most important thing is to just not have all your chips in the same basket. All right, that's all for today on the ProShares TQQQ. Let me know what you think. Are you considering this one? Is it just too much risk for you? Looking forward to seeing what you guys think down in the comments. As always, please give this video a like, share with your friends, all the things. We'll see you on the next one.